So happy to see you all again. Today we're jumping into something super exciting. Trust me, you won't want to miss this. Determine your investment capacity. This is just a guideline. You might be able to save more by optimizing your expenses. It's great that you're thinking about investing in mutual funds. They can be a powerful tool for wealth creation over time. Investment decisions should always be tailored to an individual's unique financial situation, risk tolerance, investment goals, and time horizon. What's suitable for one person might not be for another. It is highly recommended to consult with a qualified financial advisor who can assess your specific circumstances and help you create a personalized investment plan. Here's some helpful info about mutual fund investing, especially for folks in India with different monthly salaries. Let's dive into what you need to know. Before diving into specific fund types, everyone, regardless of income, should consider these crucial factors. Financial goals. What are you saving for? E.g., retirement, down payment for a house, child's education, short-term goal like a car, etc. Your goals determine your investment horizon and risk appetite. Risk tolerance. How comfortable are you with market fluctuations? Low risk. You prioritize capital preservation and stable, albeit lower returns. Medium risk. You're willing to accept some volatility for potentially higher returns. High risk. You're comfortable with significant market swings for the potential of substantial long-term growth. Investment horizon. How long do you plan to stay invested? Short-term, less than 3 years. Focus on low-risk options like liquid funds or debt funds. Medium-term, 3 to 7 years. Hybrid funds or balanced advantage funds might be suitable. Long-term, 7 years. Equity-oriented funds are generally recommended for wealth creation. Emergency fund. Before investing, ensure you have an emergency fund covering at least 3 to 6 months of your essential expenses. This prevents you from having to sell investments in a down market to meet immediate needs. Debt management. Prioritize paying off high-interest debt, like credit card debt, before significantly investing. Expense ratio and fees. These are annual charges deducted from your investment. Lower expense ratios generally lead to higher net returns over the long term. Also, check for entry or exit loads. Fund performance. While past performance doesn't guarantee future results, consistently performing funds over various market cycles can indicate good fund management, fund managers' experience, and philosophy. Research the fund manager's track record and investment approach. Diversification. Mutual funds inherently offer diversification, but it's important to diversify across different types of mutual funds, e.g., large cap, mid cap, small cap, debt, and asset classes to reduce overall risk. Systematic investment plan SIP. This is highly recommended for salaried individuals. SIP allows you to invest a fixed amount regularly, e.g., monthly. This helps in rupee cost averaging, buying more units when markets are low and fewer when high, and instills investment discipline. You can start SIPs with as little as 500 or 1,000 per month. You can also opt for step-up SIPs where you increase your investment amount periodically, e.g., annually, in line with your salary increments. General mutual fund considerations for different salary levels monthly, take-home salary and INR. Here's a general overview, keeping in mind that these are broad guidelines and a financial advisor will provide personalized advice. Scenario 1. Monthly salary, $25,000. At this income level, the focus should be on disciplined saving and starting with a manageable investment amount. Prioritize building an emergency fund. Investment amount suggested, $2,000, $5,000 per month via SIP. This is a suggestion. Actual amount depends on expenses and savings capacity. Likely goals. Building an emergency fund, short to medium term, goals e.g., a down payment in 3 to 5 years, or starting long-term wealth creation. Mutual fund types to consider. For emergency fund, short-term, liquid funds offer high liquidity and aim to preserve capital. Returns are generally slightly higher than a savings account. For long-term wealth creation, if risk appetite permits, index funds, e.g., Nifty 50 Index Fund, Sensex Index Fund. These are passive funds that track a specific market index. They have very low expense ratios and provide market-linked returns. Good for beginners as they don't require active management decisions. Large cap equity funds invest primarily in well-established large companies. Generally less volatile than mid or small cap funds, offering relatively stable growth. Flexi-cap funds invest across market capitalizations large, mid, and small cap, allowing the fund manager flexibility to invest wherever they see opportunities. This provides diversification and adaptability. Tax-saving ELSS funds. If eligible for Section 80C tax deductions, ELSS equity-linked savings scheme funds offer tax benefits along with equity exposure. They have a 3-year lock-in period. Scenario 2. Monthly salary, $50,000 with a higher income. You might have more disposable income to invest and can consider a slightly more diversified portfolio. Investment amount suggested, $7,000, $15,000 per month via SIP. Likely goals, medium to long-term goals, e.g., retirement, child's education, buying a house in 5 to 10 years. Mutual fund types to consider, continue with index funds, large cap funds, and flexi cap funds as core holdings. Hybrid funds, aggressive hybrid, or balanced advantage funds. These funds invest in a mix of equity and debt. Aggressive hybrid funds have a higher equity allocation, typically 65 to 80%, while balanced advantage funds dynamically manage their equity and debt allocation based on market conditions. They offer a good balance of risk and return. Mid-cap equity funds. These invest in mid-sized companies with higher growth potential than large caps, but also higher volatility, suitable for investors with a moderate to high-risk appetite and a long-term horizon. Debt funds. For debt allocation or specific shorter-term goals, consider short-duration funds or corporate bond funds, depending on the specific goal and liquidity needs. Scenario 3. Monthly salary, $100,000. At this income level, you have significant investment capacity and can build a robust, diversified portfolio aiming for substantial wealth creation. Investment amounts suggested, $20,000, $40,000 plus per month via SIP. Likely goals, ambitious long-term goals like early retirement, significant wealth accumulation, and potentially diversifying into international markets. Mutual fund types to consider, a strong foundation of index funds, large cap funds, and flexi cap funds. Mid-cap and small cap equity funds. Given a long-term horizon and higher risk tolerance, allocating a portion to mid and small cap funds can provide higher growth potential, but be prepared for higher volatility. International equity funds, FEOFs fund of funds. To diversify geographically and gain exposure to global markets, e.g., U.S. tech stocks, emerging markets. This adds another layer of diversification. Diversified debt funds, depending on specific income needs or a portion for capital preservation. Various debt funds, e.g., gilt funds, banking and PSU debt funds can be considered based on duration and credit quality. Always remember, investing involves market risks. Read the offer document carefully before investing. Thanks for tuning in, friends. We really appreciate your support, so don't forget to like and share the love. Subscribe. Catch you soon with more fun videos.